Okay, good morning, good afternoon, good evening, everyone. My name is Salma Ibrahim. I'm Professor of Accounting at Kingston University in London. And today we have an exciting speaker, Haifeng. It's also exciting because it's the final workshop of the season. And we'll get started back off again in September, October. First, I'd want to talk about our presenter, Haifeng Yu, who will be presenting his paper, Does the Stock Market Allocate Capital Efficiently? Evidence from Aggregate Earnings. So Haifeng is a professor of accounting at Hong Kong University of Science and Technology, and his co-author on the paper is here also attending. Haifeng has research interest in analyst behavior, fundamental analysis, security valuation, and market efficiency. Just before we get started, some housekeeping. If you can please keep your mic off during the presentation so we don't have any background noises, but please do keep your video on for participation. Haifeng has asked for the first 5 minutes to be interrupted during the presentation, or no interruption during the first 5 minutes, and then feel free to ask questions. You can raise your hand or type your question in the chat box, and I'll be monitoring that, and I'll call upon you if you do have a question. That's it for now. So without further ado, Haifeng.
Okay, yeah, thanks, Selma, for the introduction, and thanks to Steve and Ayun for the invitation. And thanks to everyone for coming to the workshop. So today I'm going to present this paper about how does the stock market allocate capital efficiently, evidence from aggregate earning. So as Selma introduced, so this paper is co-authored a joint project with Guoman. So he's in the Zoom. So he's here too. So if you have a question, difficult question, that will be directly to Guoman. So he will be able to handle all the difficult questions. Okay, so let me first just give a little bit of a motivation. So the very fundamental principle of capitalism is that the resources, scarce resources, should be allocated primarily through the market mechanism, right? The stock market is one of the perhaps one of the most important venue for capital allocation, especially for equity capital allocation, right? In a market economy, like in the US, right? So stock market play a very important role in allocate equity capital, right? So even though it's very important, it's play very important role, allocate a lot of equity capital, but it's still unclear whether and to what extent the stock market allocate those equity capital efficiently. So on one hand, it's I kind of believe that stock prices are very efficient, right? Informationally, so it's actually often claimed to be one of the most informationally efficient prices in the economy, right? Because the market is very liquid. There's a lot of investors trading arbitrage, right? So it's making the stock price very efficient. But on the other hand, there's also a lot of evidence the stock price can be misvalued, right? And which together with the agency problem, they can impede real efficiency, right? Real investment efficiency, real allocation efficiency, etc. Right? So our research question is just try to understand, right, the extent to which the stock market allocate equity capital efficiently in the cross section, and then we also want to understand what drives the efficiency or inefficiency of those cross sectional capital allocation by the stock market, right? So that's a primary research question here. So let's first just talk a little bit more. What do we mean by efficient allocation of equity capital, right? So there is a capital allocation efficiency can be defined in a static manner, right? So in a static manner, in equilibrium, efficient allocation of capital would suggest that the marginal return to equity should be equalized across different companies, right? So so that is essentially the first order condition of the optimal allocation, right? So it can also be defined in a dynamic fashion, right? So in this kind of definition, I focus on the movement of equity capital or the change to the equity capital. So it just says, the movement of equity capital should be in the desired direction. That is, it should be moving towards more productive or profitable companies, right? If indeed this equity capital allocated towards more productive companies or more profitable companies, right? So this kind of efficient allocation would increase the subsequent aggregate earning, right? Just this should be very easy to understand, right? So if you suppose we have two companies in the economy, right? So one company is more profitable than the other.
Haifeng, sorry, just a comment, I guess. In the chat box, doesn't the word allocate imply that capital is distributed across firms? Barrett, I don't know if Barrett wants to add to that.
Oh, I put it in the chat box because I didn't want to interrupt his first 5 minutes, but I just wanted to
that's fine.
But I was just in trying to understand, what we're looking at. He's talked about allocating capital efficiently, but we're looking cross-sectionally to see how it's done across firms. And I was just confused by that because I thought allocate means you're distributing it across firms. So why say both things?
Yeah, I see your point, right? The reason we put it, we a bit emphasize this part is because there's also paper on the allocate capital, intertemporal allocation, right? So essentially you can there's also aggregate level of timing, right? So you can someone also call this kind of allocation, but I agree with you. When we talk about allocation, we should most of the time we cannot focus on cross-section or cross-firm, right? Yeah. Okay, thanks for the clarification. Okay, so just to give an example, suppose we only have two companies in the economy, right? So just say, one maybe, let's say they're next year they're gonna have profitability, like return equity of 10%, the other one have 20%, right? If we only have a limited or a fixed amount of equity, then we of course by allocate some of capital to the more productive or profitable company, then the total earning or aggregate earning of this company, this two company, should be improved, right? So for that reason, we use the effect of this equity capital allocation on subsequent aggregate earning to measure the efficiency of allocation, right? So we'll come back to this issue later again, just to give more details. So just let me first give a summary of the main results, right? So we find that a cross-section allocation by the stock market.
Actually, just another question from Ayun.
Okay, sure. Go ahead.
Haifeng, I just from your previous slide, is there any reference? Are you the first paper and introducing this new notion that we should use the subsequent exposed aggregate earnings to actually evaluate the efficiency of capital allocation, or somebody else has already used this proxy to?
So as far as I know, I haven't seen any other paper using this approach. Okay. So I'm going to talk a little bit more about the existing measures a little bit later. So if you can bear with me for a few more minutes, right? But yeah, there are some other measure measure the dynamic allocation efficiency, but none of them use this ex post measure of the effect on aggregate earning. Okay, so just summarize the results. So we find actually the evidence seems to suggest the cross-section allocation by the stock market have a negative impact on aggregate earning. So this is actually quite surprising to us as well. Furthermore, we find this efficiency of capital allocation by the stock market seems to deteriorate consistently over time, right? And in trying to understand what caused these results, right? As we find that the market seems to be chasing a growth firm with very high valuation, but those firms tend to have low profitability and free cash flow. And this kind of a growth chasing or high valuation or chasing high valuation seems to explain roughly 30% of the negative allocation effects. And we also examine the time series variation. We find that this negative allocation effect is especially pronounced during period when investors pay less attention to fundamentals. That is in period with lower stock price effectiveness and shorter investor horizons and higher investor sentiment, right? So that's kind of just a summary of the main key results. Okay, so another just a clarification slide. So we want to clarify. So this, when we talk about capital allocation, again, different people may have a different definition or perception. So when we talk about capital allocation, it could be about capital allocation by the stock market. It could also be capital allocation by individual firm, right? So we focus on the stock market allocation, but the capital allocation at a firm, when we talk about for research about capital allocation at a firm, usually it is about a manager, how manager deploy their capital among different projects, right? So in that sense, stock market may also have impact on that, right? Providing, for example, an informative price signal for management to allocate their capital more efficiently, but that's not what we study. So we focus more on the stock market. So we look at the stock market as a whole. And how we try to understand this whole stock market mechanism through this demand and supply, allocate capital across different companies, right? And how this affects the subsequent everyday earning, and how this allocation is efficient, or whether the allocation is efficient or not, right? So this is just a clarification slides. Okay.
Haifeng, sorry to stop you again. Another question from Alina. Hope that's right.
Sure, go ahead.
Thanks. So I haven't read the paper, so always risky to ask a question. But I guess I'm trying to understand. So when you think about the actuality of how these allocation decisions are made, you're kind of, you're thinking about you're saying the capital market as if it's one entity, and you're talking about the universe of equity investments as if it's one entity, where in reality, you kind of have these multiple decisions where there's the choices to allocate into R&D heavy, pharmaceuticals and technology versus not. And then within them, there is the choice, okay, well, I am a pharmaceutical focused fund. I am going to allocate among the different pharmaceuticals. So to, kind of to what degree does it matter that there's actually these multiple levels of choice in terms of, no one makes the allocation decision, I have $100 million and right. I am literally going to sit down and pick the, specific, there's these multiple kind of funneling criteria. So, I'm not sure if it matters for you, but kind of, I'd love to get your thoughts on that.
Yeah, I guess that's a very good question, right? So there's a capital allocation by individual company, individual fund managers or individual investors, right? Certainly, so that's also can be called capital allocation. So you're right. The stock market, we in this paper we kind of view the stock market as a whole. So the stock market consists of all these different investors and different companies, right? The allocation at the stock market will not really just say, there's a central planner there, but there's numerous investors. There's also numerous companies, right? Investors, they serve as a supplier of capital, and companies that serve a demand demand side of the capital, right? So this. We're trying to evaluate the collective kind of demand and supply force that play out on a whole stock market mechanism, right? How this aggregate stock market mechanism, right? They determine or affect the overall allocation efficiency, right? But it is indeed that the actual allocation decision are played or determined by many of these individual investors, right? But our view is more like a macro view, but the actual allocation is indeed played by those investors, like fund managers, as you said. Right?
Oh, okay, yeah. So I just want to so let me kind of then follow up with this. So so I think you're going to tell us about, like, again, so to me, what you said, chasing growth, I think the conclusion is going to be an inefficient allocation or some degree of inefficient allocation. So suppose two scenarios. One is I am chasing the wrong industries. So I am allocating more to the growth industries versus not. And the second scenario is within each industry, I am chasing the wrong firms. So I am overly allocating to the growth firms. Are you going to be able to, or do you have an intention to speak to which one of these is taking place?
Yeah, a great question again. So actually, you jump ahead a little bit. So we decompose the inefficiency into these two parts. We call it inter-industry allocation versus intra-industry allocation. Exactly, we did that exactly as you suggested. Okay, thank you. So now talking about the existing measure of allocation efficiency. Okay, Benjamin, you have a question? Okay, go ahead. We can't hear
Benjamin,
you.
we can't hear you. Benjamin, we can't hear you.
Hopefully, is that better now?
Oh, yes.
Thank you. It seems like you're focusing on equity capital and cost of equity capital. Wouldn't it make more sense to look at weighted average cost of capital and incorporate the debt financing? And if I understand correctly, in that case, your results are even more convincing because you might find that the equity is indeed even chasing more, and perhaps some of the more timely maybe returns for investors came actually from debt.
Yeah. Okay. So first, we don't really focus on the cost of equity capital. We focus on allocation of equity capital. But if I read your question, if I understand your question correctly, so you're alluding to, like, there's also resource allocation of like debt capital, right? So that may also play a role. So you're certainly right? So actually, I think a lot of the finance and economics paper on resource allocation efficiency or the capital allocation efficiency, they look at the aggregate, they put them together, right? They include both the equity and debts, right? Whether the debt capital allocation is efficient or not, right? That's we don't answer that question here. So we choose to focus on equity here, but because so this is really just the research choice. So that
I want to clarify. I think that if you also looked at that, you might actually find that your results are even more extreme with respect to the chasing, because debt financing tends to be less volatile, right? It changes less, it happens less often. So I think that if you look at the entire picture, you will see that probably that chasing growth statement is even more pronounced. That would be my guess.
Yeah, we're not sure, right? We could certainly look at it, right? Because the debt financing, right? One important source of debt financing is from financial institutions like banks, right? So we don't have a prediction on the banks, whether banks allocate the capital more or less efficiently than the equity. But that could be an interesting research question we could think about it. Okay. Yeah, thank you. So let me talk a little bit more about existing measure, right? So in terms of existing measure on the allocation efficiency, so there's a focus on this static kind of the sense, right? So or the level static level of allocation. So as I mentioned just now, in a static or equilibrium, the optimal allocation or efficient allocation implies that this marginal return to equity, if you look at equity capital, should be equalized across different companies. But the existing research is mainly about on the allocation efficiency from in economic literature, mainly focused on the total capital, does not distinguish between debt equity, and they're more like a focus on the allocation of labor, capital and labor, right? So therefore, they try to use the dispersion of the marginal products of capital or marginal product of labor to infer whether allocation is efficient or not, right? So basically, larger dispersion implies more inefficient allocation, right? So as we say, because in optimal allocation, right, the marginal product of input should be equalized across different companies, right? So a couple of just a point related to this measure is so this perfect efficient allocation where all the marginal product of factor same across different company. We think this is an unattainable benchmark, right? Because there's a lot of adjustment cost. We never see that happens, right? And also this rely on a lot of assumptions, which may be some of the assumption may be very it may not be very reasonable, right? So you need to have a lot of assumption about the production function, the sector and economy level aggregator of input, right, etc. Right, and also the recent research shows that this dispersion of this marginal product capital could be efficient, right, if you have adjustment cost and dynamic product shock, etc. Right, so this is on the level, right, and most of the study is in the econ literature. Focus on a change or in a dynamic manner or dynamic sense. So there is some existing measure rely on the sensitivity of financing or investment to the proxy of investment opportunities. So the investment opportunity could be, for example, a Wegler et al. Use this industry, use value added as a proxy for investment opportunity. So Wegler look at the elasticity of industry investment to value added. So if there's a lot of investment to industry with high value added, then they interpret this as a evidence of efficient allocation. And perhaps more popular, another very popular measure is to use the sensitivity of industry funding rate to like Tobin's Q, right? Use a Tobin's Q as a proxy for this investment opportunity, right? But again, for both cases, this measure of investment opportunity are ex ante measures, right? So, but ex ante efficient does not necessarily mean ex post efficient. A high Tobin's Q could result from equity overvaluation, right? Like stock price is too high, this company's Tobin's Q will be high, but the real investment opportunity could be very low, very poor, right? So we see a lot of cases, right? Stock, there's a bubbles, right? When there's a dot-com bubbles, a lot of companies have high Tobin's Q, right? But if you capital flood to these companies, this will not be put into more productive use, right? That will not be efficient use, right? So we use ex post measure. Okay.
Haifeng, you have a question from Barry?
Sure.
Yeah, Haifeng. Yeah, so I haven't read the paper in great detail, but what is essentially, so you're finding that current period equity investments are negatively associated with aggregate earnings. You're ahead, and then you do some other analyses where you expand that horizon. further into the future. I guess what I'm trying to think about is like, what's your null hypothesis? Is your null hypothesis that there should be no association between current equity investments and future aggregate earnings, or is your null hypothesis that it should be positive? I guess, and like, what's your counterfactual? So,
yeah. So if okay, so just like so that hypothesis, if it's kind of related to this level, right? If the market is already if the allocation is perfect, right? So basically, all companies, they should have the same level of marginal return to equity, right? In that sense, in that hypothesis, there should be no correlation, right? But if we think that the null hypothesis that the adjustment, so we're not in the perfect static equilibrium, but we're always moving towards this more efficient allocation. So in that case, you should expect the capital should flow to more productive firm, and you should expect a positive correlation, right? So does that answer your question?
yeah, I guess, I mean, it answers my question. It's intuitive, but I guess you've got a whole setup where it's, you've got a negative association, but it's like, well, compared to what, right? Like, so would we be better off making no equity investments? Like, would we have higher aggregate earnings if there were no equity investment?
Yeah.
Like, I'm struggling because there's no counterfactual to say, well, it's worse than it would have been if we had not made these equity investments, or I think you do something with a portfolio of passive equity to try to randomize it. But I guess like, it's just hard to understand what this means with no legitimate like counterfactual to what would have happened with different capital allocation.
Okay, so we do have a benchmark. We say, benchmark towards a random allocation or passive allocation. Like this is like almost like an analogy to this passive investing, where all the company just get the, so you invest based on the market capitalization, right? So we benchmark towards a passive allocation where each company just get a fraction that proportional to their pre-allocation book value, right? So if we compare to that benchmark, so we find this actual allocation make it worse, right? You can also compare to the case there's no capital inflow or outflow or allocation at all, right? In that case, it's also negative, right? So to some extent, this result is surprising, but we do have some benchmark, right? So hopefully that we'll just in a couple more slides, when we talk about our the development of our measures, right? That should be more clear. Okay.
Yeah, it's just it's a little hard to know what to take away, because you're saying with that random one, it's like, well, if we just gave everybody, what they asked for based on their past sales, we'd be better off without doing any screening or underwriting, right? Or it's like people walk into Shark Tank and everybody gets an investment, commensurate with their past sales, and there's no actual decision making. I don't know. It's just hard to argue that you end up with better capital allocation by giving to, anybody with bad projects. So anyway, it's going to be a hard thing to persuade people that we have systematically just completely inefficient capital allocation that results in worse earnings. You'd think GDP would be going down instead of up, if that over time, if that were the case. Anyway, I'm wrestling with that. And so just food for thought as you wrestle with it too.
Yeah, I hear you. And actually, when we first see the results, we are perhaps as surprised as you are. First, we are not really advocate that we should shut down the market, right? It's just do not allocate at all. But nevertheless, that's kind of results, right? Suppose we have a passive allocator. The actual allocation seems to be worse than that, right? So our point is that maybe by looking at what is the reason, right, to cause that result, hopefully we can improve, right? But frankly speaking, we were surprised as well. But just to take one step back, right? If you think about on an investment, right? Not about like the allocation of so if you look at the stock market investment, right? There's a huge debate on the passive versus active investing, right? So in some sense, this is similar, right? In stock market investing, there's a lot of research showing that active investing, by selecting which company you want to invest more or less, and make this active bet, does not really actually underperform simply just passive allocation, just allocate according to their market capitalization, right? So in some sense, the result here is very similar in terms of equity capital allocation into different companies. Maybe this passive kind of allocation is not really bad, right? So we always think by active allocation, we have a lot of information. We do we're trying to find good companies, but maybe in reality, there's a lot of noise trader. Investors are influenced by this market sentiment, right? So which lead to the actual allocation being not as good as we had hoped, right? But so anyway, I agree with you. This result, it's in some sense we cannot even hope our result is not as strong as we see, but that's the result we get. We can talk more about it when we talk about the results.
Couple more questions. So Ayun first.
I haven't. I'm gonna be short because I do want you to have time to kind of talk about that decomposition. I think that is a great innovation. I feel like you are running into the same situation in asset pricing literatures, try to kind of like assessing efficiency, but you kind of have a joint test of a moving or dynamic business fundamental or environment at the same time. You don't know where we are in the stage of efficiency. So there are three things I kind of like, it came to my mind when I read a paper. One is ex post versus ex ante measure. I think that you still have the same issue that you use ex post measure, but you don't know ex ante when those fund managers, when they allocate, actually they allocate correctly or efficiently. So that we still don't see that. And because business fundamental or environment changes, competition changes over time. So maybe ex post may not be equal to the ex ante. The second thing is, the second thing is you focus on aggregate earnings. I kind of feel like you're missing out the risk element. Is that is kind of capturing potentially cash flow, maybe seems inefficient, but potentially there's a missing or omitted variable related to risks associated with that cash flow. And then the last thing is, I think when you talk about the literature from economics, those are more related to operational investment. It would be nice to see, in addition to equity financing activities, what kind of firms they are high growth firms related to your results, so we can see whether we overinvest in, for example, pharmaceutical R&D firms, but underinvest in some safe, more mature industrial firms. And that will actually bring us back to operational decisions and like Cobb Douglas functions that related to that econ literature you just kind of brief on. Yep.
Okay, those are great comments. So as you say, we look at ex post efficiency compared to ex ante. So these two are definitely is not the same. But if a market have some information to predict future fundamentals, hopefully, this ex ante efficiency will lead to some kind of ex post efficiency. But I think it's interesting to look at both, right? Ex ante, ex post, right, to get a complete picture, right? Okay, what is your second?
Steve has another question.
Okay, let's Steve ask a question first.
I'm on. Okay. I'm interested in Barrett's frustration there, and I guess I sort of share his frustration. There's a lot of conjectures about what could be going on, and all sorts of things could be happening here, which I wonder whether you can get it more. I'm looking for some grounding. Okay. And if we start with theory that we've got to model the investor. Okay, is that the investor's doing something wrong here? A basic asset pricing theory says we allocate capital across firms in terms of the marginal utility of consumption in future dates relative to the current marginal utility of giving up consumption. That's the model. I believe there's a theorem that says that will give you the optimal allocation for investment also, okay? So what's going wrong? What's the friction in that model? What's going wrong here, okay, relative to sort of the asset pricing description and the theory? It'd be very helpful if that could be laid out to get us going. Does it require that actually there's inefficient pricing relative to the pricing of a general asset pricing model, okay? And what could that inefficiency be? What is, for accounting point of view, what would be the accounting implications? This will give us much more grounding, okay? There's all sorts of stories and noise and all this sort of thing going on here that you're referring to. There's too much of it, in my mind. To get us really sort of grounded from basic principles would be very, very helpful.
Yeah, okay. Well, we'll think more about that, Jay. So like get a more solid theoretical background for this research. But all this, I think this finance theory, this important kind of condition is that, you know, you have this good, how to say, you have, you need to have a rational, the prices should be efficient, right? You have some good information. But as I said, maybe this inefficient, there's price inefficiency, right? So which was not considered in many of the model actually play a very important role in this actual allocation, right? So so our second question is about risk. So we address that issue. We control for risk. So we're going to discuss the results just in a few minutes.
Well, I think that'd be helpful because, you know, if in fact prices are set to satisfy the consumer investors' optimal consumption decision, it would seem to me that you've got to introduce something that says it departs from that there is inefficient pricing. Okay.
Yeah. Right. Okay. Yeah. So yeah, we'll think more along that line, right? See whether we can make it more clear. Okay. So our approach is we focus on dynamic allocation. We look at the change, right? So whether this change through this equity transaction, such as issuance and repurchase to the equity capital, whether this really adjustment is towards more productive companies, right? Whether the capital flow to more productive companies, and we examine this efficiency by looking at the impact of this adjustment to subsequent aggregate earning. As we discussed just now, we're going to benchmark against a random or passive allocation, right? So test out the cross-section allocation effects, right? So we look at ex post profitability rather than ex ante proxy for investment opportunity, as we discussed, right? And so our measure will also help us allow us to understand the economic magnitude of this allocation efficiency or inefficiency. And as we'll see, the measure also very intuitive, right? So it's measured intuition that efficient allocation should require capital to flow toward more productive firms, right? So let me quickly talk about our decomposition framework, right? So this is actually quite easy, quite simple. So we just look at aggregate earning of a particular year. Let's say aggregate earning of a year T+1. So this is just a sum of earning across all companies, and this so this can be so this earning is a book value times return equity of that year, right? It's very simple. So, and then book value, the beginning year of book value. So this can come from, we can decompose that in the beginning, the book value of the prior year, plus the earning of last year, and plus the equity inflows, and minus the equity outflow, or we just call it dividends, right? So essentially the book value consists of, we put these two together, the first two together, book value plus earning. Assuming there's no equity transactions, right? This would have been the book value of equity. So we call it book value before equity transactions. The inflow minus outflow or dividends. So this is a net equity financing, right? So we simply just plug this into the book value. So we get this the aggregate earning. They can be decomposed into a component attributable to book value before equity transactions, and a component attributable to equity net equity financing, so-called net equity financing of a company. So this is very simple decomposition. And so the second, this is a component of aggregate earning that attributed to all this equity, new equity capital transactions, but not all of this amount are due to cross-sectional allocation effects, right? So assuming, if you sum up the net equity financing across all companies, so we basically get aggregate capital flows, right? So even if, this aggregate flow is allocated randomly or passively, so you would still expect this aggregate capital flow to earn a certain amount of aggregate earning, right? So if it is allocated randomly or passively, so we would expect this amount to earn average profitability, right? So we use average profitability, calculate average profitability as a weighted ROE that weights by the book value before equity transaction of the firm, right? So this essentially can be a passive benchmark. So we need to subtract this out, right? So we subtract this out. So this aggregate, this earning attribute to aggregate capital flow. So we can get this second part, right? So this will be this part will be attributable to allocation effect, right? So now we decompose aggregate earning into three components, right? The first one is earning attributed to capital in place, right? Earning to the book value before equity transactions. The second component is the earning attributed to aggregate flow, capital flow, and third component is aggregate earning attributed to cross-sectional allocation effects. Okay, Steve.
Yeah, I got a problem with this NEF thing, this aggregate capital flows. I mean, you can make investment by actually issuing shares, or you can issue bonds, okay? You can have a stock repurchase and get reduce your capital flows and equity and have a borrowing. It seems like you're missing something. In fact, it's sort of violating M&M here, okay? That's all driven by stock issues and dividends and repurchases, which as M&M says is not relevant. You go and borrow. That may hark back to Dan's point about considering the bond market also, where in fact actually the consumer investors want to invest in bonds and you issue bonds.
Yeah. So bond definitely is one source of financing, right? So our original goal is try to understand the capital allocation by the stock market. So yeah, we didn't really consider the bond in this research, but we'll think a little bit more how this will affect our results. Whether
a lot of firms have stock repurchases.
A
lot of firms have investments with stock repurchases. Okay, so it's the investment in the productive assets is not driven solely by the NEF.
It is not. It is certainly not, right? So, but I'm just thinking how that will affect our decomposition framework, right? Because so far we don't have any. We don't have any assumption about capital structure or anything. We just try to focus on the impact on aggregate earning.
No, but the question is,
I'll think a little bit more about that.
The question where you're making a mistake. The NEF, if I actually issue a bond and buy back the stock, the NEF changes, but the investment doesn't change at all in the productive assets. I'm just issuing a bond and buying back the stock.
Right, so that I agree. But yeah, but it's wrong. I'm saying the investment of this particular company doesn't change, right? But
no, it doesn't. So it's wrong. What you're saying is wrong.
No, we look at a cross section. We look at equity capital, right? So, but you repurchase so that some shareholder get this equity capital. If they use this equity capital in another company, right? So this will become equity capital allocation. So we're not looking at individual companies, their investment decision. We look at the capital allocation decision of a stock market, right? So I will think more about it. Think more about.
I'm saying just
have.
look at companies that have negative equity. Starbucks has been very productive, but actually just has stock repurchase as negative equity. Okay, because it does this is just M&M inconsistent. So it's theoretically wrong. That's what I'm saying, and you've got to face up to that.
Let me think more about it. I'll try to understand better what's the implication for that. But from this framework decomposition, I don't see that. So we're looking at a cross-section allocation of equity capital. So certainly, you can use borrow money to repurchase, right? If that help you to increase your profitability, that's efficient. That'll be efficient, right?
That's a zero NPV transaction if it's all done at market prices.
Yeah. So again, we'll think about the equity capital across different companies, whether it's flow towards a more profitable, productive companies or not, right? But let me think more about that later.
Haifeng, we have another question from Jill.
Okay, go ahead.
Sorry, hope you can hear me. I've been having connections issues, but I mean, I'm picking up on Barrett's point, and I think Stephen's as well. There needs to be some assumptions on what is an additional dollar of investment is going to do, or capital allocated would do to profitability. And you know, there's the production-based asset pricing literature always assumes that you invest another dollar, your returns would decrease. So it's a decreasing return. Right, so every dollar. And again, there's we can argue where it's completely exogenous, but when it really gets to Barrett's points, like what is the theory behind of what is your expectations when you start off? And to me, it's natural to think about it as a declining. So as you invest more, it will decline. You'll keep investing as long as your cost of capital basically as long as it's still worth it. Basically, it's like if that returns is higher than the cost of capital. And this gets again to Jung's point on the risks. When you're looking at these high growth firms, I mean, or the high market to book, for example, high Q, is it because they have lower cost of capital? And if that's the case, then you would expect the returns, you'd expect this negative relation. And it's really, I'm kind of combining all the stuff that I've heard before to like, what's the benchmark? And I think that's where I agree with Barrett on that. I'm just trying to, what am I supposed to see if the capital, it seems that you seem to be expecting it as I invest more, I'm going to be in the more profitable, and I'm not sure that that's the right benchmark.
Right. So on a time series, if one particular company invests more with diminishing margin return to investment, you certainly expect them to have the profit going to become lower, right? But on a cross section, let's say, you know, suppose all companies have a similar technology, right? So if one company get financing, the other company lose financing, but the company get financing after they get financing, so their profitability is even lower than the other firm who lose financing. So those will tell us this company perhaps already overinvest, right? That's why you know
it's the marginal of the future. So that's where the point is. It's marginal of the future. So it's like I invested additional dollar in my company, right? Versus additional dollar in a Jung's company, and it's still. I mean, did I make a mistake? It's declining. But if I made it, if instead of investing in me, if you invested in a Jung, would it decline by more?
Right. Okay.
So you're talking. It's like I'm trying to figure out that's really assuming, by the way, assuming it's all declining, and that's kind of what we're working with based on the assumptions of production-based asset pricing, right? And it's all there, you know, the Zhang work on that. It's
So we really, you're referring to that we should look at a marginal return to this new equity investment and to see whether this capital flow towards company with higher marginal investment, marginal return as well. We should focus on marginal return. Is that what you alluded to?
It's more, it's to some degree, yes, but it's the marginal future, and it's when you make. So I always tell my my students when I teach them decision making and managerial accounting, the opportunity cost is never recorded because I didn't take it, right? And what you have is what they've decided to do. Right, and you're seeing it's lower profitability. You could have done something else, and well, maybe that would have been. Would that have been better, worse? And it's and so, what about the risk component of it? Am I willing to take the risk to take it better? Maybe I don't want to take the risk to take better. I'll take a bit worse, but with lower risk. Okay. So the first about this the future marginal return. So we try to do like estimate this, right? So here we try to estimate marginal return to new equity investment in future. So basically, assuming if there's no new equity financing, this book value of before equity transaction will earn the same profitability of as last year. So and then we can take out this part from the actual earning next year. We assume this is earning that attributable to new equity financing, and then we divide this by the new equity financing, right? So this will be a proxy or noisy proxy for this marginal return to equity, this new equity investment, right? So, and we still find this actual allocation is also negatively correlated with this measure, right? So I'm not sure whether this helps, right? But this could be a noisy proxy for marginal get to the notion of marginal return to this new marginal return to new equity investment. Okay.
Haifeng, I'm cognizant that we're almost out of time, so maybe I'll ask you just everybody keep their questions for now, just so you can have 5-6 minutes to complete the presentation, and maybe have a few minutes at the end for questions.
Okay, good. Okay, so let me just quickly, I think the main result is just the first few tables, right? So anyway, so we can, so this is our measure. So we get this, so decomposition, and we use this part to measure the aggregate earning attributed to cross-sectional capital allocation. And then we scale this by the absolute sum of absolute value of net equity financing. So this will give us for each dollar of net equity financing, this allocation, what is the dollar impact on aggregate earnings? So we call this, we use this as efficiency measure. So the data is pretty standard, just accomplish that and crisp data. So here is what we find. So we find this aggregate, so this is aggregate earning, right? Over the last several decades, is every year. So the average aggregate earning is about half, so this about 500 billion. So actually, capital in place, the earning attributable capital in place is higher. So aggregate the aggregate earning attributed to the flow aggregate capital flow is negative because the net equity aggregate capital flow is negative, right? And cross-sectional allocation effect is also negative, right? And so we look at efficiency based on year T+1 profitability. So the efficiency is about negative 0.07, and use the profitability of year T+2 is about the same, and T+3 is both about the same. Just for each dollar of cross-section allocation, it's decreased aggregate earning about 7 cents, right? And then we look at do this we did this decomposition of the inflow and outflow, right? Because net equity financing can come from inflow and outflow. And we find this both inflow and outflow that contribute to this inefficient allocation. And this is about inter-industry versus intra-industry allocation we talked about before. So we find that most of this inefficiency actually come from intra-industry allocation. So this is within industry, whether you allocate to more profitable or less profitable company actually. So this is it seems like the within industry allocation, investor got it wrong. Okay. So this is we try to explain the negative allocation. So this is essentially just reflect that the net equity financing is negatively correlated with the future profitability, right? That's why we have this negative allocation effects. So we just look at a cross-section correlation between NEF with future profitability. And we find it's always negative, right, and highly negative. So, and this is about related to the question that I asked earlier, whether this is because of risk. So whether, for example, company get financing, they get a lower future profitability because those companies are less risky. So actually it's not a case. So even after control for this various risk measure, capital and beta, return volatility, earning volatility, so this relationship is still negative. So risk may not explain this negative correlation. Okay. And this is a bunch of robustness check, right? So I just talked about here already. So ideally, we should look at whether the capital flow towards company with high marginal return to equity, right? But marginal return to equity is very difficult to estimate, right? So we just use this noisy measure, and we find it's still negatively correlated. We also use various other profitability measure, right? This cash flow based profitability, ROA, return on investment capital, and we also adjust for R&D capitalization. And also we try to use the net equity financing. We use a cash flow statement measure as a primary measure. And we also use try to use the clean surplus to infer the net equity financing by looking at the book value change and comprehensive income. And finally, we also look at use a capital market based measure, right? And we also look at value creation over long horizon, like up to year T+10 and even beyond, right? So first, the negative correlation between NEF and future profitability are robust no matter which measure we use. We also use the return to market value equity, right? Still negative. And the adjusted is still negative. And use NEF measure, alternative measure of NEF, it's negative. And use both alternative measure NEF and return on market value equity, that's still negative. You look at the correlation with profitability after year T+10, it's always negative. Even with the market to book value, market to book ratio at year T+10 is also negative. Okay, so and this is the result for using the marginal return to equity. It's still negative. It's less negative, but still negative, right? Because the sample is much smaller. Okay, so we also try to understand how market allocate capital. So we just look at so we just look like for the sake of time, we just directly look at a regression. So here we regress the NEF on various measures. So we find this allocate to less profitable companies, high growth companies.
Haifeng, sorry, we just have 1 minute left.
Okay.
And this maybe conclude.
Okay. So I think that the main results is perhaps it's a negative impacts, right? So those results we just try to understand what is going on and what is drive these results, right? So the time series variation, and so we in time series variation I just talked about. So it looks like when the market pay less attention to fundamental, the effect seems to be stronger. So that's pretty much all the main results, right? So basically, we're surprised by the negative impact on aggregate earning, but we'll take into consideration of how this debt, how debt financing may affect this. So we thank for the comments and we'll think more about it. Okay.
Thank you very much, Haifeng. Thank you for your presentation. Thank you everybody for the comments and questions. Right on time. So I think, Haifeng, you mentioned you're happy to stay beyond if there's any further question. And maybe just to finish up, to say that this is the final presentation of the season, and for next, yeah.
Yeah, so
call for paper for the next round next year. Deadline September 6, 2022. Yeah, thank you so much, Ayun.
Yeah, thank you, Haifeng. Thank you so much for wonderful. Yeah.
Thank you.
Haifeng is willing to stay a little longer. Yeah.
Organizing.
Thank you,
Thank you,
Stephen.
Thank you, Gail.
Good to see you again too, Stephen.